Hello and welcome to BloombergQuint. Moody's Investor Services downgraded India's sovereign rating by one notch on Monday evening. They've also retained a negative outlook on India's country rating. Joining us to talk us through some of the key factors behind the downgrade is Fang. He's at the Sovereign Risk Unit. He's joining us live here this morning on BloombergQuint. Gene, thanks so much for taking the time to speak to us. I have a bunch of questions, but I am going to start with sort of the core emphasis in your release yesterday. And I'm paraphrasing here, but essentially you seem to suggest that India's policy-making institutions have limited space to reverse a period of extended slowdown, the financial sector stress, and the strain on India's government finances. Can you tell us why you believe this? Are you essentially saying that we are out of fiscal space, have limited monetary policy space, and that financial sector policies employed so far have not really worked in easing the strain?
Actually, I think it's a little bit broader than that. I think what we're focused on when we think about policy implementation really goes back to some of the broader policy reforms that we saw coming through when we upgraded the rating to Baa2 in 2017. And at that point, we did expect a broad range of policies, including GST, including the bankruptcy code, to help push India's economy gradually towards a more sustainable level of high growth, and that would in turn help to bring the fiscal burden down to more manageable levels. Now, those reforms have come through, but as we mentioned in our press release, there has been some challenges in terms of implementation, and as a result, it's really the outcomes of that broad range of reforms and the challenges around execution which have led us to the downgrade at the moment.
So is it then a corrective rating in some ways that what was anticipated improvement due to these reforms has not come through? It doesn't seem entirely that, though, because you do talk about the fact that growth rates have not lived up to potential. You talk about the fact that the government debt to GDP ratios have risen and the financial sector stress, which continues to sort of prevail. So is this a combination of a corrective rating change based on what you had done earlier and what has happened since, which is further deterioration of the outlook rather than an improvement?
I think it's really focused on our expectations for the credit going forward. So I think when we put the rating on a negative outlook in November, we were highlighting a lot of trends which were already pointing to a slightly negative direction, and that included a slower trend in growth and rising challenges in the financial sector. At that point, it was more focused around the non-bank financial institutions and some of the stresses that we're seeing there. But I think we were taking a forward-looking view at that point on where things might evolve, and I think the current rating also reflects our expectations that challenges will continue to be very difficult, especially with the coronavirus outbreak, but not only because of that. I think we are focused on the challenges of slower trend growth going forward, regardless of whether or not the outbreak was in place, and that was something that we were pointing to as far back as November last year.
Okay, and I'll get to the COVID-19 outbreak and its impact, but is it rare for you to downgrade a rating by one notch, but also retain a negative outlook on that rating? I think while some had anticipated post your last negative outlook that there would be the possibility of a downgrade, but the negative outlook along with the downgrade seems to have come as a surprise. Why have you retained a negative rating outlook?
I think the negative outlook really points to the intertwined or mutually reinforcing weaknesses that we now see in both the economy and the financial sector, which is to say that, as the economy weakens, we expect to see more stress in the financial sector. And as we see a more stressed financial sector, we do think that there will be more challenges in terms of a stronger economic recovery. So I think that puts a considerable amount of downside risk into our baseline expectations. And it's a type of risk which is, I think, significant enough to factor into a negative outlook.
Okay, let me come to some of the immediate concerns. How important a factor was the COVID-19 outbreak and what it is doing to both India's short-term growth, but also sort of exacerbating some of the stress points like we talked about earlier, such as the debt levels of the government and also the financial sector stress. Was that a tipping point, so to speak, in your decision to downgrade?
Not really. I mean, I think, in fact, obviously COVID-19 amplifies a lot of the challenges, but we've been pointing to a lot of the negative trends even before COVID-19. And you can even see that the growth number for the latest fiscal year that ended in March 2020 came in around 4.2%, which is already lower than what we were looking at when we placed the rating on negative outlook in November last year. And at that point, we were pointing to the risks of a prolonged period of lower growth as a potential consideration leading to a downgrade. So I think a lot of those factors were in place, and obviously the risks that we saw in the financial sector have also, and to some extent, evolved from just an issue in the non-bank financials to including higher risks for the private sector banks as well. So a lot of those negative trends were already evident before the outbreak of the coronavirus disease.
Okay. And on the growth front, as you said, we had been seeing a deterioration for a while, even before this crisis hit us. What, to your mind, have been the key contributors to below par growth in India?
Well, I think for a while we've seen kind of tepid job growth, lackluster private sector investment. I think a lot of that is tied to challenges in the financial sector. So I think that in a way it's been a slowdown in reform momentum, which has helped contribute to what we think will be a more prolonged period of slower growth. And as I mentioned earlier, a lot of that was to some extent unfolding even before we saw the coronavirus outbreak. So a lot of it comes down to the reform momentum and where we think that's evolved in the past couple of years.
So you would then say that after you're expecting a 4% odd contraction in the Indian economy in FY21, you see that rebounding in the next year, which is statistical to some extent. But beyond that too, you see growth at what, around 6 odd percent, which you continue to see as below potential?
Yeah, around 6%. Obviously, there's a lot of uncertainty in trying to do those sort of long-term forecasts now, but I think 6% is important to us because we had seen the economy grow incredibly at around 7 to 8% 2 or 3 years ago. So I think that does reflect to some extent the impact of the current coronavirus outbreak and the way in which India's economy is positioned to recover from that. And I think a lot of that comes down to challenges in policymaking, challenges in managing the financial sector, and challenges in terms of the space the government has under the current fiscal constraints.
Which allows me to talk about the government's finances. Again, what has been your view on, first I'm talking about the central government fiscal deficit, the fact that now for 2 years running, we have not actually managed to meet these set targets. Is that a negative in your view, given that we have an FRBM Act, but we have started to veer away from it, at least in actuality, if not in target setting?
Yeah, I think the individual instances of not being able to hit a fiscal target were not in and of themselves negative, but seeing that persistently recurring did raise some concerns. And I think that's helped lead to India being in a relatively weaker fiscal position going into this coronavirus outbreak. And it does, to some extent, raise questions in our mind about how quickly and how effectively the FRBM targets can be brought back into focus, even after the situation begins to normalize in terms of the health outbreak.
Jean, one criticism right now is that any rating agency which looks at government deficits or government debt to GDP negatively at this stage is perhaps doing a little bit more harm than good, because when you're restraining the government from taking action here in India, even ahead of your rating, there was a lot of worry about whether the government should impart a large fiscal support package to the economy just for the fear of a downgrade. But this is happening across the world. Do you look at this relative to what is happening in other countries as well, and then say, okay, a 2-year or a 1-year veering away from an earlier preset fiscal path is acceptable in the current situation? Is that in your calculus right now?
Well, I would say that we are trying to take a very measured approach to the broad range of fiscal, and we're seeing very unusual fiscal policy around the world. So we're taking that into account, and we want to keep all our ratings in kind of the right relative order. But in this case, I think the rating action that we took on India, as I mentioned earlier, really points to a lot of trends that were already in place and unfolding prior to the outbreak of the coronavirus and the effect that had on the government's fiscal position. So I think in this situation, we will continue to look at how various economies, including India's, can recover, both in terms of growth and in terms of its fiscal positioning. But really, the current rating action was really driven by factors that we were monitoring and already concerned about before the outbreak of the coronavirus and before that effect on the government's fiscal position.
The same holds true for the debt to GDP ratio. I think you pointed out in your release that it was well above the median of the peer-rated group. And also, I think locally, the chatter is that if you move up to an 80% debt to GDP, to bring it down even by a few percentage points, you need to have nominal growth, which is much higher than what we've been running for 2 years. So it's a combination of the fact that we don't have that high nominal growth, but we have already high debt to GDP, which is rising further.
Yeah, I mean, I think that ties into the negative outlook that we have. I mean, we do think that the debt burden or the debt to GDP ratio will stabilize at around 84% or thereabouts after when we look out in the 2 or 3 year forecast. But that presumes nominal GDP to be at around 12%. And obviously, as I mentioned earlier, there's significant downside risks to that forecast because we have a weak economy and a weak financial system, and those will tend to sort of reinforce each other in the sense that the weaker the financial system is, the more difficult economic recovery will be. So there are downside risks to that forecast, including to the nominal GDP forecast numbers that we have.
All right. Jean, a couple of last questions. One on monetary policy. How do you perceive monetary policy space and effectiveness in India? I ask space in the context that we've already had steep interest rate cuts from the Monetary Policy Committee. There has also been some sort of blurring of lines between the functioning of the Monetary Policy Committee, which I know you had acknowledged as an important reform in India. There is now some blurring of the role of that MPC vis-a-vis the RBI. Plus, we've had steep rate cuts, which actually haven't had too much impact, leading to questions about whether policy space exists and policy effectiveness is there. Your views?
Well, I think the monetary policy steps that we've seen so far have been effective in providing some liquidity relief to the overall system. But I think the key concern for us is when credit will flow more effectively in the system. And I think that goes back to one of the concerns that we've talked about a lot here, which is that challenges in the financial system are very important right now, resolving those challenges in order to get credit flowing and in order to help in terms of the growth recovery.
Okay, and any concerns on the fact that the Monetary Policy Committee's lines, the inflation targeting lines, are getting a little bit blurred, or is that something that is sort of very much a local preoccupation right now?
I think that's something that we're monitoring, but I think that overall, these are very unusual times, and I think we want to see how that plays out in the medium to longer term.
All right. A last word, Jean, then on some of the policy priorities that could help take us at least from a negative outlook to a stable outlook. You talk about some of the factors which could permit that. What, to your mind, are those policy priorities for India right now that can act as correctives to at least its outlook, if not its rating immediately?
Well, I can't speak specifically to any sort of policies, positions, because we're not here to sort of advise on policy. But as mentioned in our negative outlook and the factors that can bring that negative outlook back to stable, what we'd like to see is a better coordination between what's happening in the financial sector and how it could reflect back onto the economy, so that there's more support for a recovery and more confidence that we can build in to the outlook that we currently have and the stabilization for debt trends going forward.
All right, Jean. I'll leave it at that. Thank you so much for your time here. That's Jean Fang of Moody's Investor Services, giving us a slightly broader view of their rating action on India yesterday. Their rating has been cut by 1 notch, and the outlook on it is negative. Thanks for watching, Bloom.